Gold and silver has the most functionality. It has the broadest base of buyer. You want that broad base so that there's more participation. Then that is a conservative position, and that is a much less volatile and stable position. Because there's always a buyer for gold and silver, since it's used across every part of the global economy. Interfund lending happens behind the scenes. You probably didn't even know about it, but it's the ability of one fund to borrow from another fund up until March 23rd in the same family. And that means that even if you are sitting in what you consider the most conservative fund, let's say government money market fund, the reality is it is only as safe as the riskiest of those funds, because that is a borrowing. So they use whatever equity is in there. But what happened last March, or not last March, but March 2020, there was clearly a run. And so they changed the rules. And what they did was they permit funds to use additional funding and other tools to manage their portfolios for the benefit of investors. Garbage. For the benefit of the markets. And how did they do that? Well, the relief that they put in place is designed to provide funds with additional tools to manage their portfolios for the benefit of all shareholders, as investors may seek to rebalance their investments. In other words, sell. And they have to come up with money for liquidation, because if they can't, you know about it. So it is in the investor's benefit for you not to realize that there is a run happening by borrowing the money for those liquidations from the other funds. Now, as long as more money comes in, they have the ability to pay that. So if the stock market goes up, okay, then people put more money into stocks. And this can remain hidden. But it gets even better. In other words, mutual funds, okay, so they appear to have the liquidations. But further, this was necessary, this is how they justify it, necessary and appropriate to the public interest and consistent with the protection of investors, because if everybody else is running and you're sitting in the fund, then you eat it in the shorts. That's what happened with back in 2008 with that prime money market fund. It broke the buck. In other words, it went below $1 per share. And since fund companies try and make sure that it remains at $1, so you think of it like it's a savings account, you don't realize it. And hey, have we not been talking a lot about reverse repos and what's happening in the money market funds? I mean, they're not as safe as you think they are. And this just adds another layer of susceptibility here. It's not a good thing. Stocks of 40 times profits are cheap. No. 15 times earnings is the average that a reasonable stock valuation. So we know markets are severely overvalued because of all of the new money that has gone into them. But hey, if it keeps going up, this is like, going and playing the big six in Las Vegas, and you put your money down on a square and you spin that wheel, and if it hits, you make a lot of money. And if it misses, you lose everything. And pretty much that's what this feels like to me. Stock market, again, has made like 40 some odd new highs this year alone on that massive liquidity bubble, which includes margin call, which includes the margin debt. Never, ever, ever forget this one. This is probably the single most important concept for you to understand. Confidence maintains order so that they can continue to rob you of your work and your wealth, and you comply. You just keep your wealth in there. You keep putting new money in there. But consumer sentiment plunges to the lowest level since 2011. A stunning deterioration, far more than the Fed or any of the economists anticipated, just like last week's CPI and PPI, so the inflation numbers exploded much higher than was anticipated. So the Fed can keep coming out and saying everything is transitory as much as it wants, but it doesn't look like the public is buying it like they once did. We are a consumer-driven economy. Something like 70% of all of the money that flows through the system is based on consumers' purchases. So it's not good when consumer sentiment plunges because people don't spend money as freely. Consumers see inflation going out. This is not transitory to them, and it's not transitory, period. And for those big ticket items like real estate, autos, durable goods, well, inflation causing sticker shock. You think real estate went up on average, so some places were more, some places were a little less, but they went up 23% year over year. This is your house, your home, but Wall Street is involved in it. So it's not really a big shocker, and they have access to money for free. And even when they take on debt to build or to buy, what do? They package that debt into a financial product and sell it back to you in your retirement plan, in your 401k, etc. In the 70s and the 80s, inflation was a bad word. And I remember that. I remember having a 5-year CD at 15%. So it's kind of good for me. But generally speaking, and I was young then, so who really even knew? But inflation was not a good word. It's become, well, they've been trying to stuff it down our throats that inflation is good. Well, a lot of the economic growth is based on inflation, because if they can force you to spend $20 on a banana and you gotta eat, you gotta have a banana, that goes into the GDP. See how great the GDP is doing? Except when you take it down to the individual level and the individual's going, yeah, well, I just got this great raise, but I still can't afford that banana. Maybe this is not so good for me.